What I sort of wanted to start off on, we've got another sort of conflict starting to arise, which probably has a more impact in the Western Hemisphere down in Venezuela and Guyana. Uh, Last Sunday, there was a referendum passed by 95% that the population in Venezuela supported um, enforcing their territorial claim on Guyana, which you can sort of see that in the picture there. This dispute's been there for a long time, going back to the mid 1800s, but it's never been resolved. The key thing is here there's significant oil resources in that area that they're laying claim to, and Maduro seems to be wanting to press the issue at the moment. Uh, Interesting underlying point is Guyana's increased their oil production and exports threefold over the last couple of years. So it's going to be interesting to see how that evolves. I don't think it'll be a military conflict, basically, from the point that Guyana does really not have a military at all. But it could prompt some actions and intervention by the U.S. But it doesn't seem to impact the oil market yet, but it is very close to the U.S. sphere of influence. We do have a vested interest in that area, and it's just another geopolitical issues that is adding risk and uncertainty to the whole global market there. And that's in addition to what we're seeing in the Ukraine, in Israel, and also the tension in the South China Sea. Okay, next slide there, please, Rich. Next thing I wanted to talk about was just the oil situation. This is uh, West Texas crude. It's actually come down in the last couple months and steady, but it's still at fairly high prices. We've seen that stabilize, but this is important because this is what's really drives a good chunk of both the corn and soybean complex these days, and we continue to watch this. I've got no insight or being able to predict where oil prices and energy prices may go, but this is a key factor we continue to watch. And the situation in Venezuela, Guyana really is adding some additional uncertainty to this. Okay, next slide, please, Rich. The dollar index is something we keep an eye on. Now, this dollar index is a bit misleading because the biggest impact on this and drivers of this is the EU and the Japanese yen. And inflation in the EU's come down from the high teens earlier in the year down to what did you say, Dan? 7.5% or so, or four, and maybe it was four in October. So that's giving a bit of stability to the to the dollar. But we continue to export inflation with our high Federal Reserve interest rates, and a lot of our importing countries. That's resulting it devalues their currency, resulting in a very high price in U.S. dollar terms. China's an example of this. Even more to the point, places like Pakistan, where their currencies collapse, Sri Lanka, and some other places, they just continue to be in an increasingly precarious situation in their foreign currency situation. So we just continue to watch that. Hopefully, we'll see some stability in this going forward, but a lot of that's going to be driven by the U.S. Federal Reserve and what they do with interest rates. Okay, next slide. There. What I want to, three main areas I want to talk about in transportation. One is the Baltic Dry Index, two is the Panama Canal, and three is the Mississippi. And this has impacts on spatial relationships or markets over distance. One thing you might have noticed in Antonina's slides is the spreads between the FOB. I'm assuming those are FOB prices comparisons. And as we see freight rates increase, those FOB to FOB comparisons will increase because it takes or the freight advantage countries that are closer to high destination markets have an increased comparative advantage. So next slide there. The first one I want to highlight is this Baltic Dry Index. And in the last 5-6 days, the Baltic Dry Index, which these are the vessels that haul primarily coal and iron ore, about 18% of that volume is grain, has more than doubled. It's now up above $3,100, and it's increasing for a number of reasons. One is we just need more capacity because and in the dry bulk ocean freight sector, one, vessels are having to travel a longer distance due to disruption in both the Panama Canal specifically, as well as the Suez Canal and generally, and also from where they're having to source grain from. They're having to make longer hauls, and that means you need more vessels, more capacity, and that's starting to rally this dry bulk freight market. Okay, next slide. Here you can see that again over a long term. This goes back to mid 1980s. The big spike we saw there is pre-global financial crisis. We did see a spike back in late 2021. That was driven by a China-Australia conflict, mainly by iron ore, but we're starting to see those higher levels in freight prices again. Okay, next slide. Next, we've heard a lot about the Panama Canal. They're experiencing quite a bit of dry weather with low water capacity in the lake. They need water capacity to lock those ships through. That's resulting in decreased lockings as well as decreased draft rates, both of which significantly reduce capacity. In November, they entered in a slot. You now need to approach where you have to book a locking slot to go through there, and they're limiting the lockings on each day that you need to go through that canal. Next slide, please, there, Rich. So this sort of shows the number of transits on the left there, the black line. Generally, they were locking about 45 vessels through a day. That was dropped to 32 in October, 25 here in November, and that's projected is not a hard enough word. They're going to reduce those lockings going forward through till February, and that just limits capacity. So some ships are taking alternative routes. In the grain market, it hasn't had such an immediate impact in the loading of vessels, but it has shifted the demand from the U.S. Center Gulf to the Pacific Northwest. One reason we have seen cheap prices, export prices at Center Gulf is because all that, particularly in the wake of Chinese buying, has shifted to the PNW, and we have relatively good basis values and cash prices for the PNW relative to Center Gulf. Just coming into the delivery market for December, for instance, December corn, we were seeing delivery value equivalents of Gulf prices below futures prices, which sort of is bearish flat price, and it's also going to increase out the board spreads in Chicago as the market starts to converge here. Okay, next slide there. These are sort of the quick calculations of what we've seen. The increased cost of that auction has put about $30 a metric ton onto prices. And that I'd say is a fairly conservative approach at the moment. This is, if we can shift the grain through West Coast PNW loading, we haven't seen that same sort of impact. But if you wanted to transit a vessel through the Panama Canal, that's been the impact. Okay, next slide, please. And this slide I just talk about the shift as China comes into the market, and as we see significantly more purchases from China for both corn and beans. We may reach a point where we need to have the Center Gulf capacity to export that, and I sort of anticipate that in the first quarter of 2024, as China still needs to buy significant volumes of both corn and beans, and they've been in the market recently buying wheat, particularly soft red winter wheat. The soft red winter wheat comes out of the Center Gulf more so than the PNW. We could have an impact on that, but we'll keep a close eye on that as we move forward. Okay, next slide. Moving into the Mississippi. Mississippi rivers had low water this year, like last year. Drafts, I think, are about 10 and a half feet, not quite as shallow as last year, but still fairly shallow. And that does have a potential to significantly increase barge freight. However, without the export demand there, we've actually seen barge freight stay historically for a harvest period fairly low. Okay, next slide there. This is a graph. The top dark line is barge freight comparison. If we go back to last year, 2022, we saw through the harvest period, barge freight reached about 1,200% of tariff. Compared to this year, the highest that it reached was just about 600. Interesting thing that we saw in the middle of October, and this is the middle of gut slot harvest, we saw barge freight drop below 400% of tariff, and today it's below, it's approaching 200. It's weaker again today. That's basically telling me there's no demand there. And it's very unusual to see that drop in the middle of harvest. Usually that doesn't happen till the end of the harvest and farmers are done. But what I would suggest is farmers stop selling corn because of the low flat price in the middle of corn harvest and just decide we're going to put it in storage. We're going to hang on to it. We're not going to move it. So the need for the country elevator or the capacity for them to move company-owned grain on through just fell off real quick. It'll be interesting to see what the December stocks report in January says to see if what that on-farm and farm ownership is in the marketplace. But that's been the impact of your low flat price, and farmers have just quit selling. Okay, next slide, please. This is where barge freight was at last week. The key one that we watch is the Illinois River freight, because that's directly pertinent to Chicago futures delivery and stopping. We saw a good number of deliveries as first notice day was last week, and barge freight's actually continued to drop in the last today and yesterday there as well. The other one we watch is the St. Louis one. That's a big large grain loading point there as well, and it's down below 300% now. So we'll continue to watch that very closely. If the export program picks up, we would expect freight and transportation to pick up in there as well. Okay, next slide. All right, yeah, look, that's all the macro points I sort of wanted to make. That sort of sets the stage because for Dan's discussion here, because those issues are across all the commodities, whether it's wheat, corn, or the oilseed complex. So Dan, did you want to add any comment or insight on that from your perspective?
Dryness in the Mississippi River system hasn't been an issue so far because of generally slow exports, except for soybeans. Is that your thought?
Yes.
Guy?
Yeah. No, exactly. We just haven't seen that export demand. So you don't need barge freight if you don't have export demand. So there has been some business moving down that way, particularly the demand that moves east to Europe and Middle East and Africa. But it's the fact China's come in lately and bought some corn. They've got record corn purchases to date, and they're going to be a big buyer. Not all coming from the U.S., but our capacity to shift those exports internally, domestically, to the PNW rather than having to transport through the Panama Canal makes a big difference. Makes a big difference in ag commodities.
Yeah, Rich, I'm doing pretty good here. I think you probably see two screens. I think I need to consolidate those screens real quick, right?
Yes, go ahead and up there the display settings. The middle one, display settings.
Display settings.
It's the second one from the left.
From the left, okay. Oh, I see. On mine, it's hidden. There you go.
Okay.
All right.
And then duplicate. Yeah, there you go. You're good.
There we go. Well, I appreciate the chance to speak with you, and we'll respect your time and hit on what we need to hit at. Just quickly on global weather, U.S. and global weather. Of course, there's the U.S. drought monitor, and for us right now, main crop that's in the ground would be hard red winter wheat in Kansas and Oklahoma, Texas. Somewhat north, you've got winter wheat elsewhere, but So we're watching crop ratings, not a big issue. And I guess in most cases, unless we just have dire weather from now through February, we'll probably still start to really pay attention to this all that much more once we break dormancy out in February and March. But then what we are watching on the international side, again, you can see the dryness that we have in the U.S., what that looks like on an international map. Looks pretty isolated. You can see again, Iowa, northern, eastern Nebraska, et cetera, showing up Kansas. But the issue in the market right now, of course, is more the set of weather conditions down in South America. You can see, again, Rich, can you see my pointer as I move this around?
Yes.
Okay, good. Thank you. So you can see the wet area that's impacting a lot of Argentina, et cetera. Generally thought to be positive. Some crops getting too much rain. In parts of that, you can see the dry area we've had concerns about also. So this is playing out, and certainly the strength in the soybean market has a lot to do with how we got to this place. Weather forecasts supposedly for more better chances of rain in a week or two. So so we're paying a lot of attention to this, and we've just started December. So hang on for the next couple months. And this map doesn't show much in terms of weather problems in Europe and the Black Sea region. There are some other maps. The NASA GRACE map shows more concern in the Ukraine part of the country, et cetera. Now that's, again, I understand. I'm sure catch what Antonita talked about, that they're not seeing a lot of problems. So we'll probably go with this just to know that there's different information out there. South Africa is an important exporter. Really, probably more of an issue right now. Some of what has driven, what I guess we'd hypothesize has driven China into the wheat market has been too much rain. That happened around their harvest time frame, hurt the quality of their wheat, drove some of it to feed use instead of food use. So they've come into the U.S. market to make up some of those differences. And of course, Guy, you're probably more in tune to talk about Australia than I am, if you'd like to comment. But we've gotten distinctly more moisture on the eastern part of Australia than we had. Any comments?
Yeah, the ABARE just came out yesterday with their revised estimates of 25.5 million tons. That's up a bit. The rain there was a little late. There was a bit of concern on the harvest, but look, they've come off 3 record years of crop. Their winter crop's down significantly, and as you can see, that east area there of Australia has been significantly damaged, and even yields decreased a bit. The other thing, just to highlight a bit, there is India. India's put export restrictions on rice and wheat, and they're struggling for dry weather there specifically.
Right, and they're highly motivated, just like China, for geopolitical reasons to protect food supplies. So they're perhaps quicker on the trigger to do that than some other places might be. Let's talk about corn markets. Just the biggest picture right now, and I have the Deese contract up here, and of course we're in the delivery period for this. The elevators are pricing now off the March contract, but I wanted to show you where this is at. So we're and note we have the relative strength index, a technical indicator on the bottom, indicating where this market has come down to. And as you look at basically pretty much a sideways to lower movement, Guy, which you'd mentioned about storage of grain. Again, this is December, but you see similar patterns in the deferred contracts. And 468.5. Closes yesterday. From what I can see today, we're down about 2 or 3 cents. So this chart, along with this one, this is a weekly chart. And note down here that kind of a low standard deviation. It's not a highly followed technical indicator, but it's just indicating there's not much news in the market. There's not a lot causing a lot of volatility. There is the possibility of the the weather conditions, the dry weather conditions in Brazil, rolling over and affecting the second safrinha corn crop in Brazil in the future. So that's an issue out there that could impact the corn market. But just note, we've come down here into this from August to September, October, November, December, and we're just sort of moving around. You look at this chart, noting the basically managed money or speculative traders, and note the growing negative positions in that market. This would be in terms of millions of bushels. So it's noteworthy to me when you look at the scale here. The red would be the short positions to sell. The blues would be the long positions, the buys, and we're getting down into areas where we hung out pretty readily when we were back in from the 2014 to the 2020 timeframe. Just a lot of bearishness, etc. But yet, so we're down there. But a lot is bet on. Bet's not the right word to talk about in the futures. A lot is invested on the idea that corn crops will come through in the southern hemisphere, and that we won't have any shortfall. So therein lies, I think, the seasonal uncertainty that we're looking at this year. Would just note basis levels for corn in a couple key locations: Central Kansas, Salina, Western, South Central Kansas, down at Wright, Kansas. Basis is pretty flat. Not a lot of excitement. Mark the blue basis, the blue line, the blue dotted line, 2023 on a weekly basis. And you can see we're much weaker than we were during the dry period of 2022. So we've returned to some semblance of average. Not a lot dry, not a lot of shortness driving that market. I was talking with someone on online prior to hopping on here, and the question that's directly in front of us is storage. Is it profitable to store corn? Looking at the this is a combination of a Kansas seasonal average price index over the last 20 some years, and what we can deduce from the futures, and assuming a level basis going forward. And that's the key assumption. So here right now we're November into December, and generally from here we'd go pretty strongly up into June for the markets. And if anything, the last 5 years, this has been exacerbated, this move, even more than it is right now. This is a 20-year average, more so now. So right now, if there's no basis appreciation, no basis improvement, the futures, which is what the red line represents, then we wouldn't have much return to storage from where we're at. Maybe some from December to Jan, and a lot of that's contract rollover. But the regular seasonal price in the index for Kansas is a lot stronger. So if it puts people in a challenging mode. Alan Brugler's on this. I mentioned about interest costs coming into play. I don't explicitly have higher interest cost involved in this calculation, but if so, higher interest costs makes the barrier of profitability for storage that much more. So I sure appreciate his comments on that. I just to show you real quickly here, the issue we had last year was, we had record high corn acres. It'd be a question this year with high soybean prices, so corn. What will we do? Will we strongly increase soybean acres? The thing the bell that goes off in my mind, and probably all of yours too, if you're watching these markets, is that we've anticipated that 1 or 2 years in a row that higher soybean prices would really change the acreage mix. One thing we come back to, I think, is the economic concept of comparative advantage. We're really good at growing corn, and people realize that. So we tend to continue to do that. So we'll see what happens this spring. stocks, the key issue in the markets for a lot of the bearishness is that, hey, the stocks numbers over 2 billion bushels, 2.15, 2.16. There's a USDA report coming out on end of this week, the DEES report, anticipating just about this to be pretty much unchanged. And with that, you can see the stocks to use jumping higher to 14, 15%, basically back to where we were during that lower price time frame. So that's, I think, what the market is kind of looking at. And with that, 14.9% dropping off from the highs last year, 654 down to 485. That's the USDA projection. Now, note on this slide that I acknowledge the USDA's number, and then say it's Dan O'Brien's own judgment, there's about a 40% chance that they're right. And that's mainly because just so much is probably going to change just before we get to the end of this market year. We're just at the beginning stages of it, or first third of it. So here's some things that in my own judgment to look at, some changes that could come. And either the USDA projection is the scenario number one. Number two, higher ethanol usage. That could eventually work its way into the USDA numbers. Higher exports. I'm trying to put a probability estimate on what looks to be likelihood of lower corn production, at least less than the extreme record high from down in Brazil. So higher ethanol on the one hand, higher exports, they both happen. So even with all of that, all those changes, if you get a full 150 million bushel increase, supplies are about unchanged. You basically would take prices for the marketing year average price from the USDA is projecting about 485 right now. You take it about it'd be 40 cents higher, up to 525. That would help to bring returns to storage. I'm not cheerleading for that, but you've got some things in the works that we're probably not. The market is pretty myopically not accounting for right now, that could come into play on the corn market. And with that, so you can see how that whittling down of stocks to use brings to a general increase in prices, about 498, 513, 525 for those different scenarios. So in all of that, I'm saying there's about a 40% chance by my own estimates of the USDA numbers being right, about a 60% chance of that number, those prices moving higher on somewhat of a tighter stocks to use. I would say internationally, and again, Guy, we've had other meetings where we've really focused on the international side, and we have a number of things we could use, but for this, we're focusing here for corn. Would say you've got the current situation. You see that red line? That's banking on large crops down in Brazil, and with that, you get that increase of about 20 million metric tons in ending stocks. Stocks to use increasing some. So, and again, this is a crop that's been being planted. Most of its development's coming December, January, February. So there's a lot on the come in the future for this scenario to work out. But that's the one that the market, I think, is attending to at the moment. And you can see the difference here between world numbers and world minus China numbers, and that the large difference in ending stocks in the world, either the whole world together or the world minus China, and how that affects stocks to use. Guy, I know you've commented on this in the past. Any thoughts on what you're seeing here on these latest set of numbers out of China?
Yeah, just two comments. China in November imported a record 4.2 million tons of corn, and I think they're going to have a record import of corn this year. Interesting, in November, 83% of that it was from Brazil. And if you look at Brazil's current lineup, Brazil still has a fairly significant lineup for both corn and soybeans down there, which is they haven't run out yet, and i.e., since they're selling cheaper than the U.S., we haven't seen that shift to demand from Brazil to back to the U.S. Keep in mind, Brazil is going to have more exports of corn. Well, this past year they did, and this coming year they will, more than the U.S., which is a change, particularly in corn. And we're starting to feel, definitely feeling the impacts of that. And I think that's the new paradigm of the new world that we're living in, as Brazil continues to expand and grow their production.
Like to move pretty quickly through sorghum. This sorghum chart for exports just looks so-so when you look at the pace of in the black line of 2023-24 exports, but it looks tremendous compared to the pace of wheat and to the pace of corn for exports. So we have seen some business, especially of late, in U.S. grain sorghum exports. Almost all of it, 90% of it or more, going to China for domestic alcohol products that they put together. And with that, interesting, in the Salina export-oriented part of Kansas, you see the grain sorghum basis trending higher positively in more the feedlot-oriented sector of the country. Out in the western feeding areas, you see a pretty flat basis. So that's kind of the story right now in Kansas with sorghum. We're seeing some pretty strong prices in the export areas, and just really less so in the feeding areas. Sorghum acreage, we'll see where that goes this year. We did see a rebound last year. So much depends on how dry it is, I think, and also whether these price advantages that sorghum has in some of these areas sustain themselves out into the coming months. And just pretty tight. It's interesting to see the last 2 years for U.S. grain sorghum yields. Kansas, involved in that, have been a couple of the lowest years that we've had for a good long time. So, of course, grain sorghum grown mainly on dryland areas, non-irrigated mostly, and that's what you see. Let's talk on soybeans, and then I'm aware we're pushing to the end of our time here, so let's go quickly. See, the concerns in South America have certainly impacted the futures prices of the January contract. And note, it's a different looking situation than you saw for corn. We have the soybean risk right in front of us. The corn risk, that's off in the future. So you're seeing that issue right there. And note that we spent above with an RSI technical indicator number over 50% positive for a good while, have come down below that as the markets have dropped off. This is a daily January, pardon me. This will be the weekly continuous contract. And again, note, we just haven't had anything to really rile that market up or worry about since July of last year. And even, you'd argue, even back farther, 2 years ago. So we're absent something out of the ordinary. It seems that we're destined to hang out in these markets. Of course, we're coming into weather related issues for both South America. We already have them there, and we'll have some of those probably in the U.S. in the spring, and that probably will give us some opportunity. And note, we do have some bearishness that's come in on the soybean spec traders, managed money, but not near to the degree of what we'd seen back in 2019 or 20 in the soybean contract. So I guess it's you kind of look at the position of traders and take the temperature of optimism or pessimism on markets from these traders. Basis pretty much sideways, surprisingly sideways actually, with some of the export movement that we've had in the Salina area. And very, very similar. Here you got a chart where the futures right now, they show some carry for some of these commodities, but really once you come out of December into January, pretty level. Whereas we've been seeing this 20-year seasonality chart has been shifting. In the last 5 years, the highs have come more in February, March than on this 20-year one. So that's something to watch, I guess. If you're storing soybeans, and yes, I know seasonally we can have some risk out here in June and July, but if anything, we're probably gearing more off of South America weather questions, et cetera, in the last few years, and seeing returns to storage coming more in February and March. Acres, we'll see where acres come from next year. But right now, the new crop bid price ratios favor soybeans strongly in most areas of Kansas, except in Southwest Kansas. We follow those every week, but we'll see what the total U.S. does, as we come into planting season next year. Just something important to note, that domestic crush with ties to yes, soybean meal production, but also renewable fuels going strongly higher, and exports for soybeans on a fair trend downward. So we're sort of domesticating our demand sector for soybeans, especially with the expansion of renewable fuels. Still a player, but guys, you'd mentioned some of this also has to do with the growth and the competitiveness of South America. Any comments on that?
Yeah, just October crush was up 14% month to month, and that was a record soybean crush of just over 200 million bushels. And look, I think that trend's going to continue as we move forward. As you mentioned, we're shifting that, growing that domestic demand significantly, but that's going to take away bushel to bushel on the export capacity there. But the other thing internationally, China's weekly soybean crush was above 2 million metric tons last week. That continues to remain strong, China being the biggest buyer of soybeans internationally. So they're maintaining a healthy crush pace there in China as well.
We're not the first option for China with their large buying. They're going to South America first, and if they can't get it there, then they'll out of duress and need, they'll come to us. I hope that's an accurate statement.
Yep.
And note the soybean export pace hasn't been too bad, about middle of the road. Again, much better than wheat and for corn, so that's good. And also soybean stocks to use. Market watchers will look at this and say, gosh, we're just hanging around 250 to 270 million bushels. That seems to be about the norm. And we get much lower than that, we start to really hop up prices. So again, the USDA's projection, and my own thinking this early on, about 40% chance that it's right. And with that, you can see the prices that they've got, in these tighter time frames, 5.7%, 6.1, 6.2, now 5.9. We're heading up $12, $13. My own thoughts again in terms of what's likely to change. It's interesting that when you go to the back of the USDA's WASDE report and look at their production errors, it's still sizable. And if you take the plus or minus a one production error and divide it back on the acreage, you still get some variation that can happen in the yield numbers and the production figures. So we won't see that very likely. Pretty sure we won't see that in the December report, but it adds risk and uncertainty to the January report, and I believe that's January the 12th. So you have that and crush and exports. And this is sort of the secondary impact of Brazil's shortfall scenario. And so you can see you've got a couple scenarios here with my own percent ratings on them that come in with pretty tight stocks, and to be surprising given we're at 1290 what the USDA's projection. If we get a short yield in the US, short yield overseas, you come back in and you're back up to areas that we haven't been that far from here recently. So that's my own percentage projection, basically saying there's about a 44, 43% a 17% plus 27% likelihood of us ending up with pretty strong prices. So I don't want to encourage people to hold soybeans just for gambling stocks. But they are taking on risk if they hold them. However, there's some issues out there to contend with that have to be resolved. That right now they're not in front of us, so we're not looking at them. And for world in stocks to use, 10-year low in last year, and again we're counting on record soybeans out of Brazil. You can see this number here. That's a lot of that's more growth in Brazil, and if that works its way through, you end up down here. And just China soybean stocks, not as much of a differential, mainly because they don't produce as much and they're more hand to mouth. With that, we're about 10 minutes beyond the end of what we'd said. Rich, do you want me to go forward with those who want to stay, or what do you think is best?
If you could maybe just do a 5-minute flyover, but truly keep it to 5 minutes and let's call it a day.
Oh, yeah, that sounds good. Okay,
I'm gonna
folks,
have to be going myself. So
okay, for wheat, been until the last week or so, it's been rough going. Have dropped to 587 on the D's contract. Again, we're watching March now for the lead contract, and have come up here of late. 657. We've had some export business, as Guy mentioned, the soft red winter wheat to China coming into the market, so again, you're in essence we're looking at some of this probably had to do with coming to the end of the coming into the delivery period for the December contract.
yeah, I gave him 5 minutes to wrap it all up. Well, 2 minutes ago. Yeah.
Okay. Well, anyway,
if you're going by 343, I'm coming pretty soon, but I will be a couple minutes late.
Rich, I can hear you. So.
Oh, is it? Okay.
Anyway, pretty bearish.
Good enough.
Note right here on the futures, the bearishness of the contract. And in so many words, I think the bottom line of wheat is that in my own thinking that wheat is walking a pretty precarious road, in that when you look at say, Rich, I can hear you talking. So anyway, point is that we're looking at long-term record low stocks to use. The market's attention is on very competitive sales coming out of Europe and Russia. That's take front and center. We have wheat from those areas coming into the U.S. because they're low priced, and just a situation. I think we're walking a narrow, dangerous edge off into the future. As if there is a drought or a major disruption that stopped wheat coming out of Russia, Ukraine, other parts of Europe, then the world will look around and there's not many places to go. And so I think there's risk in the wheat market, but we're just not seeing anything now. So anyway, that would be my thoughts. With that, Rich, we can call it.
Okay, thanks, Dan. We would take a question or two if you want to stay on and ask anything. I don't have anything right now. If you thought of something for Antonina, I think she's still on here as well. But I think we are about ready to go ahead and end for the day. Phil, yes, all of Dan's slides are available. I emailed them out, and they are also on the website that I put on earlier. Let me put that back there. So the link for the slides is also there. I will be emailing it again when I have the recording finished. I should have the recording later today, but it might be tomorrow morning before I have that ready to go.
Roman, on that question, let's talk by email on that. that would work.
And Dan, do you see that from?
Yeah, I see what Roman asked. Yeah.
Well, from Gerardo, there's another one.
Oh, I missed that. Okay. Comments on vegetable oils. Are you talking about the carryover impact of renewable fuels upon the oilseed complex on crush? Is that what you're Gerardo? Is that what you're referring to? Well, uh, Guy, if you want to chime in on this, that'd be fine too. But plants are being built by commercial companies to tie in with renewable diesel side. It affects canola as well as soybeans, and the EPA came out within the last within the last several months and didn't give as much of a protection or as much of an acknowledgement of that growth as that industry was hoping for. But yet, so perhaps that slows it down some in terms of that the development of that industry. But generally, money is going forward. Plants are being built, so we have the infrastructure going in to continue to use oil seeds, soybeans and canola and others, no doubt for oilseed uses. And again, we're aiming at you've got soybean oil, you've had renewable diesel. Renewable diesel can be used directly by cars, straight out, without having to blend. So hits the California market, West Coast market, and finding its way elsewhere. Guy, any comments?
Yeah, no, look, that the projected ending stocks for soybeans in the U.S. are tight, and they're tight enough that your domestic crush demand is keeping that U.S. price above alternative sources out of Brazil and Argentina and other places. And although the soybean export program's picked up a bit, the crushing side of things needs to keep those soybeans in. The more interesting dynamics, I think, are going to happen in the next few months after the new year as soybeans compete for planted acres, specifically against corn, and how those dynamics are going to work out. And as Dan said, U.S. farmer likes to grow corn, and it's been difficult for other commodities to buy acres away. And that's going to be, I think, the interesting dynamics as we move towards spring.